Money Show.
Personal Finance with Warren Ingram.
There was a famous investment guy in the 1920s who went to, there's a very famous dock in New York City where all of the stockbrokers either still do or used to harbor their private yachts. And he went in there and was asking who owned the yachts. And they were invariably people connected to stock markets. He then went and wrote a book saying, "Where are the customers' yachts?" Because invariably the fund managers who manage money do incredibly well. They've got the benefit of scale and they do pool people's funds together. They charge everybody a fee and they go off and invest the money on their behalf. And provided they continue to do well, they get more people into the investments and they draw higher and higher fees. And many people in the investment industry do very well. Thank you very much. But tonight's discussion with Warren Ingram, who's a personal financial advisor and executive director at Galileo Capital, is the best way for your fund manager to add value to your money, not theirs, to your money, because that is why you give it to them to manage. You need them to make it grow, Warren Ingram.
You're right, Bruce, and I think we've kind of cottoned on to this mugs game of being an investor and paying fortunes to fund managers and watching them drive around Cape Town in their sports cars and their fancy yachts and their mountain bikes and their artworks, etc. And so what we've noticed over time is that the fees have been coming down very significantly over a decade or two. But the debate then got to the point of saying, well, actually, do these fund managers add any value at all? And I think for quite some time, the debate was strongly in favor of saying they don't add value. And I think again the world has turned a little bit, and I'm starting to think that as the world has turned and things have changed, they are starting to add value again, and all along though that needs to be priced at the right way, and not at the old pricing, but certainly if we look at South Africa as an example, it's very hard for me to argue that I will give money to a fund manager to only invest in shares and believe that fund manager will beat the JSE or the index over a long period of time. And I think the reason is that the number of shares on the Johannesburg Stock Exchange that are actually investable are so small now and so well researched that actually, buying the index, paying very, very little for it, would be a far better view than paying a fund manager. So I'd say there, I can't see that I would get value out of a fund manager. But if I look at paying a fund manager to decide to allocate money to shares, to bonds, to property, and to cash, and mixing those assets correctly, I think there is real merit in giving fund managers money to do that. And I'm not saying that we want them to suddenly become proficient market timers because history's shown that no one can time markets, so that's a mugs game. But what they can do is they can look at the stock market, for example, and they can say, well, the stock market's relatively cheap now, and so we're going to reduce your exposure to cash, we're going to reduce your exposure to bonds, maybe to property, and we're going to increase your allocation to shares. So doing it on a valuation basis and I don't want to say scientific, because unfortunately investing is not pure science. There's an element of art to it as well. But there is a merit in paying fund managers to move assets from what are clearly overpriced and expensive assets to the cheaper asset classes in the country, and then very definitely globally. So I think the answer is that fund managers are adding value, but they're actually doing it in a different way than what they did in the past. In the past, we would have paid them because we believed they would have given us great performance, done much better than the various indices they were trying to perform against. Now I think they add a lot of value as risk managers, and there is real merit in paying a fair fee to a fund manager to do that. And then
here is the question, okay? Because there are a handful of fund managers who consistently outperform other fund managers, and sometimes they even quite consistently outperform the market. And so we could then say, well, they're worth the money. Now, not every fund manager is worth the same amount of money. So how do I decide how much my fund manager's contribution to protecting the value and growing the value of my money is worth?
So the Warren Ingram soapbox says, you can't pay
this
the
is
performance
science.
fees.
This is scientific, right? Okay, because you can't. Investing isn't scientific, but this is okay. Got it. I've got you. I'm making notes.
I'll stay on my soapbox. So it's fortunately an opinion, and we know what value we can give opinions. But my view is that I think your fund managers need to charge you an annual fee. In other words, they can't say to you, we're going to charge you a performance fee, where we're going to take a share of the growth that we've achieved from your money over time. I think that performance fees are not necessarily fair to investors. But if a fund manager says, I'm happy to charge you in the region of 0.5% per year, up to a maximum of, let's say, somewhere around 1% a year to manage your money, I think that's a very fair fee for the unit trust industry in particular, because I think that it's very hard for them still to charge, let's say, just a rand amount, which is the ideal. I mean, I think the only company I know in South Africa that's got that right is Outvest, in fact, where they'll say to you, we'll charge you fixed rand amount to manage your money. And I think that is the way the industry should go. But for now, while it's evolving, especially in South Africa, I think 0.5 to 1% a year is a good and fair fee. And if you're in the region of 2% a year or more, it's time to look for a different product, because you are paying too much, and the likelihood is that your fund manager is one of those with the expensive yachts and the art and the mountain bikes, etc.
I would think that the best performance fee that you could agree to pay is to pay the 0.5 to 1%. And if the fund manager does well, they draw more money into their funds, and therefore they get paid more 0.5 to 1% of more pots of cash. Their reward surely should be a volume game, because they are consistently outperforming, and their incentive is to grow those volumes.
I think that's right. When the markets that they're operating in are very big, because their opportunities to generate good growth are there. But in a small market like the JSE, unfortunately, I think that their opportunities are limited. So, if the fund gets too big, the fund becomes, a massive oil tanker that moves moves around the basin of the yacht basin or the harbor, and moves everything around just because it's so big on its own. And so I think that's the danger of a small market. So I think bigger markets, especially global investing, no problem. There's so many opportunities, so many different markets, shares, bonds, etc. That's certainly the right way to go. But smaller markets, no, I'm not so sure. I think the other thing that's kind of happening globally, which is really interesting, is that there are some enormous companies that are doing very well, growing very well, that are choosing not to list on a stock exchange anymore. And so the opportunity for you and me, for example, to try and buy into those companies is close to zero. Unless we're worth tens of millions of dollars, and they approach us and say, would you like, we'll give you, because you've got all the money, we'll give you the chance, to be one of the handfuls of investors in our funds or in our companies. We just don't get the opportunity. And I think that's where we're starting to see value again from fund managers, because those, some of the good fund managers are being offered the opportunity to invest in these private companies. And you and I can't do it. So paying a fund manager to access the good private businesses, I think is a relatively, good opportunity to look at. Again, at the right price, at the fair fees, etc. But that's a new dynamic which hasn't really been around for quite some time. In the old days, those were private equity funds, for example, and they were really specialized at charging enormous fees. But I think the unit trust world and the investment company world has matured and is starting to look at those as good opportunities again. So definitely, I think that's a place that I would pay a fund manager to give me opportunities that I can't find. But for the rest, I'd still go into the index, for the efficient markets, and then look at fund managers to manage my risk and be happy with the combination, because I think that's really the secret in all of this.
Thank you, Warren Ingram. More with him in a moment. A question from Richard. I've got 4 years to go before I turn 60. I'd like to retire at the age of 60. A few of my colleagues think it's a good idea to move my pension fund savings to a more conservative idea to reduce the risk of losing money just before I retire. Considering what happens to the markets last year when COVID-19 hit the world, I'm starting to think it's a good idea. What are your thoughts on this? That question to Warren in a moment.
The Money Show.
Personal Finance with Warren Ingram.
Richard wants to retire in the next 4 years, wants to de-risk that process. He's worried that there's another enormous fallout on markets and he gets caught short the day before he goes on retirement. What to do, Warren?
I think it's a intuitive thing that Richard's asking. Getting to retirement, I want to protect the money I've spent so long building up, and make sure that the stock market crash doesn't wipe out a third of it. Just as I enter retirement, and so on a human level and an intuitive level, it makes sense. What you need to remember, Richard, is that you are going to live, all things being equal, you're going to live at least for another 20 to 40 years. And so that's the part of the equation that a lot of people miss when they come to their retirement thinking around their money, is that they view retirement as an absolute end, and forgetting that, it's actually just another phase of your investing career. And unfortunately, ending is only, on the day you stop breathing. And so I would say, look at retirement as a step, but that means that you're looking at how to manage cash flows. You're looking at making sure that you've maximized your tax opportunities, all of those things. But to de-risk your money means that you're giving your capital less chance to continue to grow and less chance to beat inflation, and that's really the thing you should be really worried about, is the way that inflation destroys the buying power of your money. So definitely don't look at de-risking your portfolio completely. The only time I would do that if I was approaching retirement would be if I had been taking too much risk before then, and I wanted to get to the right sort of mix of risk. But certainly, I think people going into retirement should really have about, as a minimum, somewhere around 65 to 75% of their investments in growth assets like shares or property companies and the like. To go down to nothing in shares, I think, is a real mistake. And unfortunately, that's what the pension fund industry used to do a lot in the past. But they have figured out that longevity is a real thing now, and they need to plan for it correctly. So Richard, the only time that you really take this seriously is if you've got some kind of known cash flow, some kind of big payment that you've got to pay, and you need to access some money from your retirement funds to do that. But beyond that, understand that stock market crashes are going to happen to you probably somewhere between every 3 to every 7 years for the rest of your life. And unfortunately, there's nothing you can do to predict them. And the best thing you can do is ride them out when they happen, and make sure that you've always got the right mix of cash, bonds, property, and shares. The jargon for that's the asset allocation. You have the right asset allocation, you can deal with these big moves, but trying to time the markets by being too heavily in cash or too heavily in shares, unfortunately, you're probably going to get it perfectly wrong, because that's what happens to the professionals and the amateurs alike. And so that's a mug's game. It's not worth doing. And just unfortunately, volatility of stock markets is a bit like the weather. It's going to affect you one way or the other, and make sure that you've got the right umbrella, and you'll be okay.
Yeah, and I'm just impressed that he's capable of retiring, or even considering retiring at the age of 60. That's an impressive goal reached, I think. What is a feeder fund? Let's wrap up with that. I found this term feeder fund the other day. This is the money I put away to buy pizza. But what is it in investment markets?
It's an awful name, it's typical of the industry that come up with these bad names. So what it means is it's a way of taking rands and investing your rands into a local South African unit trust. And what will happen is that unit trust will invest all of its money into a global fund of some description. It could be something that only invests in shares, or a balanced fund, or a global property fund, etc. And then the fund will then get the benefit of those global markets, whatever those markets do, whether they're rising or falling, plus also the movement of the rand against those global currencies. So, for example, if you bought a feeder fund that purely invested in the American stock market, then you would get the benefit of the American stock market's growth in dollars, and also then the value of the dollar and the way that it moves against the rand. So when you wanted to take the money out of the feeder fund again in the future, you would get the money paid back to you in rands. So that it isn't a way to send money out of the country, but it is a great way to diversify your portfolio on a very cost-effective way. So I think feeder funds are awesome for people that want to save small amounts or a regular debit order.